Most commentators are stating that we may just have one more rate cut for the remainder of the year, possibly in September. And the big banks, they're saying that we may not have any relief for the remainder of 2025. But what if I told you if we look a little bit deeper into the Canadian economic data, it paints a different picture altogether. If you remove housing costs from the inflation numbers, we're actually sitting at 1.3. And the last time we were at 1.3, we were at a policy rate of 0.25%. And with the Vancouver market stagnating, with sales dropping, pricing starting to drop, what is really going to happen and what is the path for the Bank of Canada moving forward? We're going to break it all down here today. We're going to jump right into the charts here so you can see exactly where inflation is headed. And this is what the Bank of Canada relies on to decide if they're going to cut rates or not. So with inflation in Canada on the left, you can see that essentially around 2023, when we were at our pinnacle, it has just been a straight drop downward and continuing to drop here in 2025. If we look at core inflation, it has been a drop down in around the same marker, but we have been seeing that inflation rise up here a little bit in 2025. And when we look at some of these charts and what they represent, we can see that the headline annual inflation came in at 1.7%. And that was really unchanged from April. And the core inflation, where you can see that it was rising up a little bit, was at 2.9%, which is still within the range that the Bank of Canada wants to see, between that 1 to 3% target range, which indicates stable inflation without significant pressure. And when we look at these inflation charts, we know that the Bank of Canada is really not losing any sleep over it, because they really can manipulate those numbers for however they see fit. So what do I mean by that? You can see that when we look at mortgage interest costs and the impact on inflation, mortgage interest costs contribute 0.4 percentage points to overall inflation, uniquely included in Canada's CPI basket. Excluding these costs, inflation would be around 1.3%, similar to 2021 levels. So obviously, with the Bank of Canada, they can really move those inflationary numbers. If they drop interest rates, that's going to drop overall inflation, because so much of that CPI data points is built off of those housing costs. When we look at the rented accommodation inflation trends, which take account, the rented accommodation inflation added 0.3 percentage points due to a 4.3% rent increase, but is expected to ease as population growth slows and rents stagnate nationally, which we have seen. Non-permanent residencies have just dropped like a rock, and those are the big bulk of the individuals who are using rental properties. And because so much of that segment has moved out of Canada, that is why the rental market, the biggest reason why the rental market has been so slow. So when we look at the data here and see that if we remove that housing cost, and we would be sitting at a 1.3 data point for inflation, and seeing that the old policy rate at that level was 0.25%, we have more than 2.5 percentage points to play with that the Bank of Canada has. But they're holding things tight here, and this is one of the reasons why an argument could be made that even in July we could see a rate reduction and possibly another one in September, and it could go against what a lot of the commentators are saying in the environment in terms of what to look for here in 2025. When I speak about the differences between the two types of inflationary measures, there's the headline inflation and core inflation. We're going to break that down here. And you can see that with headline inflation, it measures total price changes, including food and energy. It has a volatility difference where headline inflation is more volatile than core inflation. And then within consumer impact, headline inflation reflects direct consumer expenses, where core inflation excludes the volatile food and energy prices for stability, and the core inflation guides monetary policy decisions, with the economic indicator states that core inflation indicates underlying inflation trends. When we remove the volatility such as gas prices and some of these other markers within that CPI basket, we are looking at that 1.7 number, well within that 1 to 3% range that the Bank of Canada is looking for. And if we reduce the housing costs of 0.4, which they totally can do and within their right, we're looking at that 1.3 marker. So in terms of inflation in Canada, things are very, very stable and looking very strong. Obviously, we have that wild card down to the south of us with all these tariffs that can change that. But right now with the Bank of Canada, an argument could be made that based on this data, the Bank of Canada could drop some rates here. And with the market stagnating here in such a big way, a lot of people are in agreement that for this market to pick up, we really need to see between 3 to 4 25 basis drops to get this market going. So even if we got 2 more drops, say in July and September, I don't think it's enough to change anything, but it could start putting the framework for a stronger 2026 market, where most agents and commentators thought that 2025 was going to be a strong market within real estate, and that just has not played out. And it's because the Bank of Canada has kept their rates and have stalled out dropping them over the last few months. I want to bring another chart here on screen, and this is a great barometer to help us forecast where inflation is likely headed. And it comes in terms of small businesses and what they are planning to do with their pricing over the next course of the year. And you can see that there is a decline in planned price increases. Canadian businesses have reduced their planned price increases from 3.6% in March to 2.8% currently, with fewer expecting hikes above a 5%. And that's where you can really see that downdraft in the charts as well. What this tells us is that we can have more of an anticipation of moderation of that core inflation, as business pricing plans and cooling inflation drivers indicate that core inflation is expected to moderate in the coming months, which is another thing that the Bank of Canada is going to be relying on in its policy making decisions coming up here in a couple weeks in July and then again in September. As we drop down here and we look at the broader economic indicators that can show some weakness here, we know that consumer spending is down. Retail sales have dropped 1.1% in May, signaling a sharp pullback in consumer spending that may influence Bank of Canada rate decisions. Obviously, as rates continue to stay high, there's less money in Canadians' pockets to be able to stimulate the economy. And that's why when they do reduce those interest rates, people have more disposable income. It goes into small businesses and things of that nature. And that's another reason why small businesses are not looking to increase their pricing, because they're already having that sharp decline in consumer spending. When it comes to manufacturing sales and orders, we can see that manufacturing sales have fell 2.8% in April, with new orders collapsing 6.8%, indicating reduced demand and potentially layoffs in summer, which we already have highlighted unemployment issues across Canada and here in Vancouver as well. And then when we go to payroll declines, we see that payrolls decreased by 6,000 in April, with private sectors down 30,000, marking a rare year-over-year decline outside recession period. So this is not good news either for the overview of the economy. And as people are losing their jobs, being laid off, or a softening job market, if these people are in housing by any means, whether you're renting, whether you're owning, the Bank of Canada needs to help those people out. And what they can do, they can drop those interest rates. If they drop those interest rates, landlords don't need to get as much for their rent to cover their payments. And obviously for homeowners, if you've lost your job, it helps you survive and get through the next couple months. So these are all some indicators here, and my argument showing that we could see some rate cuts sooner than expected here for the remainder of the year. When we look at the overall market sentiment, you can see here in the slide economic outlook and Bank of Canada rate expectations. With a rise of negative GDP growth in Q2, the current data points to a likely negative GDP print for Q2 unless significant changes occur soon. The market pricing, low chance of a rate cut, which we've highlighted. Markets only assigning a 30% probability of a rate cut at the July 30th meeting, expecting just one more cut this cycle. And then uncertainty in future rate cut outlook. Rate cut decisions hinge on upcoming employment and inflation data, with potential cuts in July, September, and October. When the Bank of Canada is looking at the risks and the considerations for what they need to do, these are some of the areas that they'll be looking at for sure. Obviously, the tariff uncertainty and the delayed Bank of Canada easing, where the BOC delayed rate cuts earlier this year due to the tariff uncertainties, adopting a cautious wait and see approach while retaining policy flexibility. And that is, again, relating to the market here in terms of real estate. That's why things have really cooled off here as well. Because of the uncertainty from the Bank of Canada, it has now pushed the uncertainty to buyers. The upcoming data critical for BOC decision. The July rate cut decision depends on key upcoming data releases, including the labor force survey and CPI, which will indicate inflation trends and employment conditions. So the data that we see here, there's going to be some updates before the July meeting. But what we see with the current data sets here, it does look like there could be a framework for the Bank of Canada to drop some of those rates. With the population growth and the impact on supply and demand, we know that the Canadian population is now near zero. The population growth slowed to just 20,000 people from January to April, making one of the lowest growth periods in 75 years. And the big reason for that is just the non-permanent residents. That has just fallen off a cliff. Permanent residencies are still remaining high and around that 400,000 per year, but the non-permanents are dropping off big time. Recent policy changes tightened and temporary worker and international student programs, significantly reducing population inflows and slowing growth, which we just tucked on there. So as we package this all up, where do we go from here? And you can see we have a couple points here to highlight. Current inflation is stable at that 1.7% marker, with core inflation at 2.9% within the bank's 1 to 3% target range. Temporary factors like mortgage interest and rental price increases are expected to ease, influenced by near zero population growth and slowing rent increases. Number 2, economic indicators and market implication. Economic data shows slowing growth with declines in retail sales, manufacturing, and employment. This suggests potential rate cuts between July and October through market expectations remain cautious. Focus on labor and inflation data for central bank decisions. So this is my argument here as to why I think there is some room for the Bank of Canada to cut rates. I'm not so pessimistic where I don't think we're going to get anything. Obviously, as a realtor and a homeowner, I would love to have some easing of the policy rate, but it doesn't just affect homeowners either. It affects small businesses, it affects renters, it affects all of us here. So if we get any relief here, it does help our economy as a whole. And I think because we're within those targets, they are in a position where they can make those rate cuts. But we're going to have to see with the next data set that comes out, and I'll be doing a video on that to see where things go, and put it in the comments. Yes or no, are we going to be seeing some rate reductions here in July? I'll see you on the next one.